The liquidity mirage mechanism, how altcoins during bull markets create the illusion of deep, sustainable liquidity through speculative reflexivity, only to experience catastrophic liquidity collapse when Bitcoin dominance rotates, retail, institutional capital withdraws, triggering a cascading devaluation spiral that destroys 80–99% of altcoin value in every single market cycle without exception. In November 2021, the total cryptocurrency market cap touched $3 trillion. $3 trillion. That number felt real. It showed up on Bloomberg terminals, on CNBC tickers, in retirement account screenshots posted to Reddit. Retail investors in Manila, Lagos, Paolo, and Mumbai were watching their altcoin portfolios double, sometimes weekly. Solana had risen 11,000% from its 2020 lows. Avalanche was up 3,000% in a single year. Even Joe Coins, tokens with literally no utility, were minting millionaires overnight. By June 2022, that 30 trillion had become 900 billion. Over $2 trillion in paper wealth had simply ceased to exist. Not redistributed, not transferred, gone. Once a top 10 cryptocurrency with a 40 billion market cap collapsed to effectively zero in 72 hours. Celsius, a platform holding billions in altcoin deposits, froze withdrawals and filed for bankruptcy. Three Arrows Capital, one of the most sophisticated crypto hedge funds on the planet, became insolvent. And here is the paradox that should stop you cold right now. The same mechanism that creates altcoin wealth during a bull run is the exact mechanism that destroys it afterward. The liquidity that makes altcoins appear valuable is not organic. It is not fundamental. It is reflexive. It exists because people believe it exists. And the moment that belief fractures, the exit door that looked wide open reveals itself to be a pinhole. You are watching right now in 2024 and into 2025. Altcoins making extraordinary moves again. Bitcoin ETFs have unlocked institutional capital. The halving cycle has compressed supply. Retail FOMO is building, and every chart is pointing up. What I am about to show you is not a reason to avoid crypto. It is a reason to understand, with surgical precision, what happens next, and why the investors who survive bull market endings are not the most optimistic ones. They are the most prepared ones. Stay with me, because this script might be the most important 15 minutes of your investing education. Financial RMN experts to understand why altcoins collapse, you need to understand three core mechanisms that most retail investors never learn until after they've lost money. Reflexive liquidity and the speculative feedback loop. Altcoins do not have liquidity in the way blue chip stocks do. Apple has billions of shares traded daily against deep institutional order books. An altcoin with a 500 million market cap might have less than 2,000 million in actual daily trading volume, and most of that volume is wash trading or bot-driven activity. What altcoins have during bull markets is reflexive liquidity, a concept pioneered by George Soros in his theory of reflexivity. Here is how it works. Rising prices attract new buyers. New buyers push prices higher. Higher prices generate media coverage and social proof. Social proof generates more buyers. Each cycle reinforces the next until the external variable that feeds the loop is removed. In crypto, that variable is Bitcoin dominance and dollar inflows. When Bitcoin's dominance peaks and retail capital stops entering the ecosystem, altcoins don't gradually decline. The loop inverts. Selling generates more selling. Liquidity evaporates. The entire price structure collapses. Tokenomics and programmatic supply unlocks. This is where altcoin investors get systematically destroyed, and almost nobody talks about it loudly enough. When a new altcoin launches, early investors, team members, advisors, and venture capital funds receive tokens at prices 99% below the retail listing price. These allocations come with vesting schedules, lock-up periods that prevent immediate dumping. But here's what that means in practice. During the bull run, those lock-up periods expire. Hundreds of millions, sometimes billions of dollars in tokens held at near zero-cost basis get unlocked and become eligible for sale. The The team that bought at 0.01 is perfectly rational to sell it at 10. You, the retail investor who bought at 8, are left holding an asset being systematically distributed by insiders who have already made thousands of percent in return. Sites like Token Unlocks Investing track these schedules. In 2024 and 2025, hundreds of top 100 altcoins have token unlock events that will flood the market with tens of billions of dollars in newly circulating supply, precisely when bull market sentiment peaks. This is not speculation. This is scheduled dilution. Bitcoin dominance rotation. The altcoin killer. Every crypto cycle follows a capital rotation pattern. Bitcoin moves first, driven by institutional money, ETF inflows, macro risk appetite, then Ethereum, then large cap altcoins, then mid caps, then small caps and meme coins. This is the so-called altcoin season, and it feels like free money because everything is going up. But here is the sequence that follows. Without exception, in 2014, 2018, and 2022, Bitcoin dominance bottoms, then reverses sharply. When Bitcoin dominance rises, meaning Bitcoin's share of total crypto market cap increases, it means capital is leaving altcoins and rotating back into Bitcoin as a flight to safety within crypto. Altcoins drop 70%, Bitcoin drops another 20%, altcoins drop 90%. By the time Bitcoin finds its floor, the average altcoin is down 85 to 99% from peak. This is not a historical anomaly. It is the structural reality of a market where altcoins have no fundamental floor price. A stock has earnings, cash flows, and book value to anchor it. An altcoin with declining developer activity, token unlock pressure, and evaporating speculative demand has nothing anchoring it from below. Nothing. Let's talk about what this actually costs people. In reality, in the 2021-2022 cycle, investor who put $50,000 into a diversified basket of top 50 altcoins at the November 2021 peak. Not meme coins, not obscure projects, actual top 50 assets, would have watched that portfolio decline to approximately 4,000 to 8,000 by the bottom in late 2022. That is an 84 to 92 cent drawdown, a loss of 42,000 to 46,000 in real purchasing power. More devastating. Many of those investors had funded those positions by refinancing homes, liquidating retirement accounts, or borrowing on margin. The emotional and financial damage from those decisions extended far beyond the portfolio. Marriages fractured. Businesses that had been funded by crypto gains collapsed. And the psychological trauma of watching a life-changing sum evaporate in months produced what behavioral finance researchers call learned helplessness, a paralysis that prevents rational reinvestment, even when opportunities return. Nassim Nicholas Taleb, in his work Antifragile, identifies this pattern with clinical precision. He argues that financial systems and altcoins are a perfect specimen, appear robust during calm periods, but are catastrophically fragile when tail risk events materialize. The fragility isn't visible until it's catastrophic. Altcoins, he would argue, are not just fragile. They are negatively convex. The losses are unlimited to the downside, while the gains, however spectacular, are always capped by the eventual exit problem. You cannot sell billions of dollars of an illiquid asset without destroying its price. Here is the invisible financial loss that most people never account for: opportunity cost compounding. An investor who lost 90% on altcoins didn't just lose their principal. They lost the future value of that principal. 50,000 invested in a diversified index fund in November 2021 would be worth approximately 62,000 today. Not spectacular, but intact. The altcoin investor now needs their remaining 5,000 to produce a 1,000% return just to return to break even. Meanwhile, the most powerful variable in compounding has been consumed. This is what financial advisors call the asymmetry of losses, and it is the most psychologically underestimated concept in retail investing. The fear mechanism driving altcoin investment is FOMO, fear of missing out, in its most potent form. When your social network, YouTube algorithm, and Twitter feed are all showing people who turned $1,000 into 100,000, the rational part of your brain loses ground to the limbic system. You begin to process inaction as loss rather than safety. That cognitive distortion is precisely what market insiders rely on to distribute their token positions to late cycle retail buyers. You are not irrational for feeling it, but you must understand it, because understanding it is what separates a survivor from a casualty. Let's move from theory to the specific, documented ways altcoin collapses manifest in real portfolios and real lives, because pattern recognition is your most valuable risk management tool. Drawdown magnitude and the correlation failure. If you held a portfolio of 10 altcoins in 2022, you may have believed you were diversified. You were not. During the collapse phase, altcoin to altcoin correlation moves toward 1.0, meaning everything falls together simultaneously with no offset. The diversification that protected you in equities, where bonds rise when stocks fall, simply does not exist in altcoins. When liquidity exits, it exits the entire asset class. Investors who applied conventional portfolio theory to altcoins discovered painfully that diversification across correlated assets is not diversification at all. The liquidity freeze. Investors who held altcoins on centralized exchanges, Celsius, Voyager, FTX, experienced something worse than price collapse. They experienced complete inability to access their funds. When Celsius froze withdrawals in June 2022, over $12 billion in customer assets were locked with no recourse. When FTX collapsed in November 2022, another $8 billion in customer funds was lost. This is not a price risk. This is an existential risk. The asset simply ceases to be accessible. Every investor who believed exchange custody was equivalent to bank custody learned the hardest possible lesson about counterparty risk. Stablecoin D, pegging in the false safety net. Many investors, sensing danger, rotated altcoin profits into stablecoins, believing they had secured their gains in a dollar equivalent instrument. In May 2022, Terra USD, a stablecoin with an 18 billion market cap, lost its peg and collapsed to zero in days. Billions in safe stablecoin holdings evaporated. Even USDC, the most regulated major stablecoin, briefly pegged to 0.87 during the Silicon Valley Bank crisis in March 2023 before recovering. The safe harbor was never as safe as it appeared. Career and income exposure. The 2022 collapse triggered over 25,000 layoffs at crypto companies, Coinbase, Crypto.com, BlockFi, Gemini, and dozens of smaller firms. Engineers, marketers, analysts, and executives who had accepted equity compensation partly in crypto tokens watched both their portfolios and their income sources evaporate simultaneously. This double exposure, career income correlated with portfolio risk, is a classic systemic blind spot that portfolio theory almost never addresses. Symptom 5, behavioral finance traps, anchoring to past highs. One of the most destructive patterns observed after altcoin peaks is what behavioral economists call anchoring bias. An investor who bought Solana at 250 during the 2021 peak, watching it fall to 10, doesn't think, I should exit and preserve capital. They think it was at 250. When it gets back to 250, I'll sell. This anchoring to a past high prevents rational decision making about present reality. Meanwhile, the asset continues to decline, developers leave the ecosystem, and the probability of that 250 return diminishes by the month. They hold all the way to zero, not out of stupidity, but out of a cognitive bias so deeply embedded that professional traders have entire risk frameworks built specifically to counteract it. Rehypothecation and the off-balance sheet exposure. This is the systemic blind spot that even sophisticated investors miss. When you deposit altcoins on a lending platform, those assets are often rehypothecated, meaning the platform loans them to another entity, which loans them further, creating a chain of leveraged exposure against the same underlying asset. When Genesis, a major crypto lender, collapsed in early 2023 following the FTX contagion, revealed $3 billion in exposure tied to interconnected counterparties who had all assumed the other was solvent. This is identical to the mechanism that caused the 2008 mortgage crisis. The same asset, leveraged multiple times across institutions, with no single entity understanding the full chain of exposure. The unlearning process begins here. Stop seeing altcoin losses as personal failures and start seeing them as tuition in market mechanics. The investors who emerge from this understanding are not victims. They are practitioners, people who have witnessed from the inside exactly how these systems operate. And that knowledge, properly applied, becomes the foundation of genuine financial resilience. So what do you actually do with this? Because this is where most financial content fails you. It identifies the problem and then leaves you with anxiety and no direction. That ends here. Asymmetric position sizing. Never bet what you can't lose completely. Altcoins belong in a specific bucket of your portfolio, the high-risk, speculative allocation, and that bucket should never exceed what you can watch go to zero without material impact on your financial life. The professional framework here is the Kelly criterion, adapted for high volatility assets. Size your position based on your edge and the variance of outcomes. In practice, this means altcoin exposure for most investors should sit between 3% and 10% of liquid net worth, enough to generate life-changing returns if the thesis plays out, not enough to be catastrophic if it doesn't. The three-bucket liquidity framework. This is the framework that keeps sophisticated investors solvent through full market cycles. Bucket 1, 6-12 months of living expenses in cash or money market instruments. Completely outside crypto, completely liquid. This is your survival layer. Bucket 2, core portfolio in uncorrelated assets, broad equity index funds, bonds, real assets designed to compound through time regardless of crypto cycles. Bucket 3, speculative allocation, crypto, altcoins, early stage opportunities, sized at your maximum pain threshold. The three-bucket structure ensures that a 90% altcoin drawdown never forces you to sell bucket 2 assets at a loss to meet living expenses. It preserves optionality, volatility hedging as you approach peak conditions. The signals of late cycle euphoria are well documented. Retail search volume for crypto terms spiking on Google Trends, mainstream media running, "Should you buy crypto?" cover stories, taxi drivers and family members asking how to buy altcoins, and Bitcoin dominance beginning to reverse from a low. When these signals converge, it is time to begin systematic, staged profit taking, not panic selling, but predetermined exit rules established before emotions are engaged. Set price targets for 25%, 5%, and 75% position reduction. Execute them mechanically, then rotate proceeds into bucket 1 and 2. This is how you convert speculative gains into durable wealth. Stress, test your portfolio before the market does. Open your current crypto holdings and ask one question. If this asset fell 90% from here and stayed there for 3 years, what would my financial life look like? If the honest answer is, I would be in serious trouble, your position sizing is wrong, regardless of your conviction in the thesis. Historical stress testing against the 2018 and 2022 drawdown scenarios is not pessimism, it is engineering. The market will eventually apply exactly this stress to your portfolio. You should apply it first. As Warren Buffett has said, only when the tide goes out do you discover who has been swimming naked. In crypto, the tide has gone out before. In 2014, in 2018, in 2022, it will go out again. The duration and magnitude of the next drawdown is unknowable. The fact that it will arrive is not. The investors who will be standing on the other side, positioned to capture the next cycle with fresh capital, clear minds, and intact financial foundations, are not the most bullish ones in this cycle. They are the most prepared ones. The goal is not to predict the market. The goal is to be prepared for every outcome it delivers. If this breakdown gave you a framework you haven't seen anywhere else, and if you want to understand these macro mechanisms before the crowd does, subscribe and hit the notification bell. Every video on this channel is built on the same premise that financial intelligence, not financial luck, is what builds lasting wealth. The next bull run will create legends. The end of it will reveal who was building and who was just along for the ride. Make sure you're building.